She wants to raise some capital in order to go out and expand the business. So she says, I'm going to sell a portion of my share in the business. And now Susan is a 50% owner, and she brings in a partner, Jeff, who is also a 50% owner. Well, now we have this problem where if Susan is killed in an accident, her shares will pass to, let's say, her husband. Jeff might not be excited about being a partner with Susan's husband. He might not want to be in business with Susan's husband. He wants to make sure that there's going to be a mechanism in place for him to buy those shares. So normally what we're going to see, especially in situations like this, where you have a 50-50 ownership scenario, you're going to see a buy-sell agreement put in place. Oftentimes the buy-sell agreement is just part of the unanimous shareholders agreement anyways, and then to make sure that there's going to actually be cash available, because the buy-sell agreement only says that Susan's husband is going to be willing to sell those shares to Jeff, or is really going to be forced or compelled to sell those shares to Jeff. But Jeff's going to need the cash to do that. He doesn't magically have the money to buy Susan's 50% of shares. Where would he get the cash from if Susan died? Well, our buy-sell agreement is normally going to be supported by life insurance. So, a business like this, it would be fairly common to see a key person policy or two maybe. Almost certainly, a well-run business like this is going to have a buy-sell agreement in place with life insurance on Susan and Jeff's lives. A lot of financiers would look for that as a sign of a well-run business before they'd be willing to put any more money into the business. Susan and Jeff should really be looking at themselves to make sure that if one of them dies, the business won't suffer, and that if one of them dies, their own loved ones will be taken care of. If you look at this from Susan's spouse's perspective, well, if she dies and leaves the shares to her spouse, the shares don't do that person any good, don't do Susan's husband or whatever have any good. He really wants the cash. So having a buy-sell agreement in place will compel Jeff to pay a fair price for those shares. It'll make sure that we have life insurance in place. That is, we put life insurance in place when we put the buy-sell agreement in place. And then we're going to have those funds available. There is one other alternative, or one other policy we might put in place here, although it's less common than the buy-sell agreement, less common than the life insurance, and that is we might also have a disability policy that would pay a benefit if Susan becomes disabled or Jeff becomes disabled. And in that situation, we would have the disability benefit paid straight to the business. The business would use that money to what we can call for this purpose is buy, but actually it will be a redemption. We will redeem Susan or Jeff's shares. That's a disability buyout policy that we would use in that scenario. It's not covered in the scope of this course, but you'll even find today critical illness buyout policies being used. Normally what happens with a disability buyout policy is, let's say we have a disability buyout on Jeff. Jeff becomes seriously disabled, stays that way for a year or sometimes even 2, and at that point we trigger the disability buyout. It'll pay its benefit to the business, and the business uses that lump sum benefit then to buy Jeff's shares. So again, just a quick overview. This is fairly complicated, and the underwriting for these products is also very complicated, but it is imperative that you recognize when there is a need for one of these products or one of these applications, even if it's something that's beyond the scope of what you're actually able to sell or what you're willing to sell. Recognizing this need, you're going to help Susan and Jeff to manage their businesses and their own personal risks. If you're sitting down with Jeff and his family, for example, and you find out that he's this 50-50 owner in a business, even if you're not going to cover off that need yourself, you should say, Jeff, do you have a buy-sell agreement in place for the business? Is this something you've looked at? And Jeff might say, no, my accountant said that we didn't need one, although an accountant wouldn't say that, I know. But Jeff might say something like, no, we looked at it, but it was too expensive. Well, Jeff, maybe you should consider it because it's going to make sure that you and your family are going to be looked after. Okay, thank you very much then, and enjoy your continued studies.